Good afternoon and welcome to this week's edition of Halftime Talk. We're delighted to be joined by Mr. Edward Moya, the Chief Market Strategist at Oanda, sitting in the Upper West Side of New York City, where it's not too cold, a little bit mild. Maybe that means they're not consuming a lot of energy. But Ed, welcome.
Thank you for having me.
I suppose there's one place to start. I mean, it is a sense of a deeper dive into the oil markets. We have to acknowledge that they are hovering, holding close to that $100 barrel. We saw last week the big surge up on the Russian invasion of Ukraine, and then the correction at the end of the week. And now we started out early this week with oil prices recovering again, because the outlook for the situation in Eastern Europe is rather dire. I think if there's any other word. Looking at the $100 oil context, can it hold? Is it sufficient? I mean, putting aside, if one can, the Ukraine crisis, how much of it do you think elevates the oil price? How much is fundamentals?
Well, I think before we had the Russia-Ukraine crisis, we were dealing with a very tight oil market. And when we were, analyzing, output production levels from OPEC and non-OPEC members, there was a growing deficit. And I think there was this belief that you were really going to see that super commodity cycle trade, and oil was going to be one of the favorite opportunities for a lot of energy traders. I think there was this belief that we were going to have over $100 oil before this crisis happened. And now you're starting to see that, I think there's potential risks to some disruptions of Russian crude. There's also concerns that we don't exactly know how the demand outlook is going to unfold. I think that there's before we started the new year, the biggest risk for markets was inflation, and I think that we can't forget that. And I think that this war in Ukraine is really going to, intensify those pressures, and that's going to start to hurt the crude demand outlook for the latter part of the year. And I think that you're going to see that oil price volatility over the short term, and short term could be over the next couple months, is likely to be that we're going to see higher prices. And I think that there's still another risk where we could have another easily 10-20% higher in crude. I think that with momentum and with the way the market's positioned, we could see some extraordinary moves here, but I think that the risks are still tilted to the upside. But we have to remember, if there's any type of sign of a major de-escalation, if there's any upside surprise as far as Iran nuclear talks, we could see the market get a little bit more optimistic with that crude output production scenario, and you're going to see prices remain very volatile. But I think over the short term, there is still that belief that you're going to have continued momentum. We can't forget that the global economy was still getting out of COVID and that there's so much pent up demand, and that
it does feel, Ed, though, that given the dynamic just of the last week, that the tendency of this oil market is to want to settle down, right? The crisis in war, this massive moment in Eastern Europe, certainly has been an elevating force, let's say from the 90 level handle up to 100 and above. But when there's any sense that actually this mightn't be the Armageddon moment, it seems oil prices tendency wants to settle down, not go up. I'm wondering where you see that tightness elevation without Ukraine.
And I think a lot of that has to stem from the optimism that you're going to see the demand outlook pick up. And we have to remember, U.S. production been steady, and some of that could be attributed to the Arctic blast that we saw that hit large parts of Texas, where you did see some slowdown in production, but there is still tremendous pent-up demand, and I think that you're going to probably see the overall, travel outlook, jet fuel demand scenarios are looking a little bit better. The lack of investment in new wells is really going to provide some shortfalls. I think we have to remember, during the pandemic, every oil company had to focus on showing some discipline, and no one invested in new wells. And what you're also going to see is that
It looks like
the
that discipline paid off handsomely with the record profits we're seeing.
It did, and I think right now, if you're an oil giant, you're still focused on delivering shareholder value, and you're probably going to see that yes, there's some movement to clean energy, but the oil market is going to have severe shortfalls over these next few years, and that's just because of this lack of investment. And I think that there is this. I think with this crisis, I think over these last few months, we realized that this movement to clean energy is not going to be as seamless as a lot of people thought, and that we're really going to be vulnerable to several different shocks. And we don't. It's impossible to say what is going to be the driver behind them, but this market is going to be. I think that the risks are to the upside. And
well, let's just look at that a bit for the risks of the market. You highlighted the year started with inflation being numero uno, if you like, on that list. One would have to say it remains so in the context of the current crisis in Eastern Europe is a upward momentum for oil prices and evidently for inflation. And we were already worried at the beginning of the year to an extent that the Fed was behind the curve. Now you can't even see them in the rearview mirror. They're so far behind the curve. There's no way they get this beast under control without slamming on a recession, or they live with higher inflation. What are your thoughts on which they will choose?
I think the Fed is taking a look at the domestic situation in the U.S. is still fairly upbeat. I think that you're going to see them fight inflation, and I think right now the way the market is kind of viewing
with mittens or with 10-pounder gloves.
I think they're gonna there's going to be a lot of hesitancy in tackling inflation. I think that should be clear, and I think that a lot of traders are overemphasizing the importance of interest rate hikes, and they're not focused on the balance sheet reduction part as much so. So I think by the end of the year, you'll probably see that at minimum the Fed will raise rates four times, and I think that balance sheet could be down by $1 trillion. And the Fed believes that the economy before anything happened over in the Ukraine, that it could easily handle that. There is growing concern, though, that the Fed knew that there was going to be a recession in the next few years, and the fear is that we could have that recession as early as next year. And the way the curve is behaving and the way financial conditions are, there's a lot of nervousness there. But I still think.
Do you think they will have to choose, though? That is the question. I mean, the idea that in order to get inflation under control, 4 isn't going to do it this 4 quarter points. I mean, it's a bit like European sanctions on Russia. It ain't going to get you where you need to go to. That would be a rally in the markets. Onward we go. I mean, you're talking getting up to barely over 1%. That doesn't seem like the weapon you tackle 7% inflation with.
No, and I think what's happening is the belief was that you were going to before everything happened in Eastern Europe, the belief that we were going to see the peak of inflation right around now. Now that is getting pushed back a couple months. So I think the fear is that now the Fed is trying to figure out exactly, well, how do we change our policy, and more importantly, there's been some Fed members that have been a little bit more cautious as far as they don't know the short-term impacts of these current developments, and maybe a little bit more of a slower approach in tightening. And I think that the debate is going to be intensified, but right now everything is pointing to higher inflation, and that the peak is not here. The peak is probably going to be a couple or a few months down the road. And if that's the case, the Fed is still, regardless of what we have happen with the inflation report on March 10th, the Fed is most likely going to raise by only 25 basis points. This is a policy mistake. I think that can be, if you were to take a poll, I think most economists and analysts would say, the Fed is well behind on inflation. We should already be delivering at least our second rate hike by now.
Well, you had Larry Summers screaming on the TV over the recent weeks, have an emergency meeting now and stop buying assets. I mean, never mind rates. Stop with this easing.
Yeah, the stopping of the purchases, that I mean, there was several opportunities where they could have done that, and I think the market would have easily have handled that. And I think hindsight is like now you're dealing with a major geopolitical tension that is, oh no, like if they would have ended it 3 months ago, no one would have be second guessing them now. So now I think the Fed is probably going to continue to slowly tighten policy, but I think the economy right now, and when you take a look at financial conditions, they are weakening a little bit, and I think the market is growing a little bit more concerned that you're having incomes are flatlining, and that as you start to see Americans go more into savings, that weaker consumer is really going to be not able to handle these higher inflationary pressures. So then that's going to, I think, really force the Fed to act a little bit more quicker. So it all depends, though. If the Fed feels that inflation and they won't have an answer on this question. Is it going to peak in the next 3 months? If they feel it does and that it's starting to head lower, then they could still stick to their, behind the curve and.
I mean, I don't know how
slowly
they don't have, I mean, my sense is they don't have time for such luxuries as waiting, and we're heading for stagflation. But it seems like a luxury to be talking about such simple economic ideas when there's a raging war going on in Eastern Europe, in which one of the participants is the world's largest oil exporter, or close to sharing that role with Saudi Arabia, and growing expectation indeed that whether there's direct sanctions or not on energy coming out of Russia, the perception and banks' willingness to fund and traders' willingness to get involved with Urals and otherwise could create disruption anyway. What's your outlook and your thoughts on where, putting aside all the tragedy, but just this one particular corridor, how do you think it plays out?
I think things will continue to intensify, and that I think that we'll come to a very tense moment where that decision will have to be made, and I anticipate that traders should be expecting that there could come that moment where you see that those sanctions are put on Russian energy, and that would really, I think, make it an easy trade for
Yes.
oil and gas prices, and
I
I
mean,
think
Urals
that.
are trading 11 bucks below dated Brent. They're a bargain if you can get them and you're brave enough, I suppose.
Yeah, I really think that this is a market that you're probably going to see that there is it's going to break a lot of traders. I think that there's this fear that no one knows exactly, and when you take a look at the volatility that we just saw over the weekend, this is a very difficult market environment, and I think that for the most part, though, that the as we kind of you highlighted earlier, there is a tendency that you're seeing that the oil prices want to go down, I think, and I think that there is that kind of belief among a lot of traders, but I still think that you should not anticipate that we're going to see a major de-escalation anytime soon, and that this is going to be a very difficult trading environment, and the most important thing for a lot of traders is probably try to hedge your risk right now.
There was a sort of embedded narrative at the early part of the year. Again, inflation, part of that whole sort of outlook was it was going to be a year of two halves, a tight first half, then an easing into the second half in terms of supply demand, with the idea that Iran and other supply could come back. We've got the U.S. shale patch looking like it's got a heartbeat again, and other Caribbean, Brazil, and so forth. What are your thoughts of that narrative now? And I suppose the anchor to that narrative ultimately is the Iran nuclear talks.
I think that right now this is the U.S. the Biden administration is extremely motivated to iron out some type of deal with Iran right now, and this is an opportunity to really show the energy markets that you have the potential of having a lot more supply replacing the ones lost from Russia. Now, you can't just simply replace over the short term, Iran sanctions with Russian sanctions. That doesn't work. It'll take time for Iranian supply to ramp up, and I think that still supports the argument that oil could head higher. But there is that belief that if you do have some sanction relief, and I mean right now, if you're Iran, you're going to be able to negotiate some favorable terms here. I think that the Biden administration is um, there's several motivations right now to reach a deal, and I think politically, you have midterm elections in November, and if you take a look at every poll, you're looking at a red wave come November, which means you're potentially looking at losing, Congress, and then, come we don't even know. And by this point, the president typically announces whether or not he's running for re-election or not, and so there's so much uncertainty for for Democrats. So this would provide a minor win for them, but it would be something that they need. So I would expect that this is going to be
And
something that they'll go
it's
through.
ironic that a lot of the sounding, I mean, you still have Russia, China, the US, although not at the table, but in the room next door, so to speak, in Vienna, while all of the backdrop, you're less than a few hundred miles away from Ukraine there. Nonetheless, that's the crazy world we're living in. The looking into this week that we're sitting, and of course, we also have, and speaking of sitting at the same table, OPEC Plus meet on March 2nd to decide on their next step in terms of their rollout of more increases, 400,000 barrels a day each month we've had since August. According to reports for January, they were below that target by nearly 1 million barrels. Is OPEC Plus served its purpose on this particular cycle? I mean, any more increases sound kind of hollow.
It's difficult when you say you're going to do something and then you partially follow through with that commitment. And I think that everyone knows that when OPEC says they're going to hit a certain level, that there's going to be a shortfall. You have so many OPEC nations that, unfortunately, they were unable to reinvest in new wells. They're really struggling to ramp up output. I mean, the motivation to sell crude at $100 oil is there, and this is something that is really going to weigh in the energy complex for the next couple of years. And I think that you're probably, I think a lot of the consumers of oil and gas products are saying, like, why won't they increase at a faster pace? And I think that they are exercising discipline, and I think you have to remember the demand outlook has been extremely volatile, and now you have another wave of geopolitical tensions here that is disrupting some of the short-term crude demand outlook here. So I think that no one should be surprised if they maintain that gradual output strategy of 400,000 barrels again. And I think that you're probably going to see that the oil market it needs more crude, but OPEC is. OPEC Plus is not going to overcommit production unless they really start to see they're losing market share. And that's only going to happen if you really see the non-OPEC members ramping up production significantly. And right now, they're not seeing that. So
what do you where do you stand on that point, particularly obviously your back door, or you're not your back door, but ultimately the US in terms of the outlook for shale? It seems to be coming back. Can they be part of this new supply, this sort of helping to the second half of the year to be a little bit easy?
Well, I think for a lot of shale companies, like $50 to $60 oil gets them excited. They're like saying, like,
Yeah.
okay, we got this is our time. We're
$90,
back.
$100 must get them,
Yeah,
whatever, euphoric, right? I mean, they're
yeah.
dancing jigs with their pickaxes.
They're already planning galas. But I think that the harsh reality is that they know that eventually that you'll see prices come back down to earth. And now the private oil production is going to has been increasing. Rig counts have been steadily rising. They're they don't want to have the same lesson learned where they ramped up all these shale wells and then all of a sudden a lot of them had to
Do you think they're
cut off.
waiting to see that OPEC utilize all of it or more of its spare capacity before really turning on the jet engines on shale production? I mean, it seems that so much of the American shale patch now is in the hands of the big players as compared to the last cycle. It was in a lot of small players, so really uncontrollable. But now all the majors have all the big pieces and they're holding back. Why? Because at these prices, they could make a lot of money. So they must be a little concerned about where that spare capacity of OPEC still sits.
They are they are concerned about that, and then also too the ESG movement has really kind of refrained the rush to go back into shale as aggressively. So you're probably going to see that. I think energy markets are going to become very skeptical of anyone that says they're committing a massive investment into shale wells. So I think you're going to see it gradually increase, but I don't think that it's going to be at anything at a faster pace than we've seen in the past. And this market, should remain tight. And I think that the harsh reality is that there's going to be some difficulty transitioning into cleaner energies, and I think that you're going to see a lot of the developing nations, emerging markets are really going to be stuck using crude a lot longer. And when you take a look at how their economic recoveries have unfolded, the opportunity to move to clean energy is going to take a lot longer than I think anyone is anticipating, which should really give it kind of a little bit of a base for steady demand going forward.
Do you think the Biden administration, I mean, they have many challenges on their plate, obviously. One of them, and most front and center, of course, in America, very important, the price of gasoline at the pump. Do you expect, or would you expect the Biden administration to step back from its transition agenda and sort of encourage the fossil fuel producers in America to go for it?
I think that would be a move that would be embraced, and it would show leadership that he's realizing that they need to tweak their policy, and then they can go ultra aggressively into investing into clean energy and trying to make up for lost commitments to the Paris Accord. But I don't imagine him doing that. The President Biden has outlined several key issues that it seems he won't budge on, and I think that might be that's one that I don't anticipate him budging, and that could prove to be costly, I think, come election time, just for both the midterms and for the next presidential election.
Yeah, it'll be interesting ultimately in that point. If Biden doesn't go for re-election, he actually might get some muscular ideas to really nail down his agenda, which I suspect will happen. I just cannot believe he will seek re-election. I mean, I don't know. It seems to me that would be a big ask. Just coming back to the OPEC Plus and the intersection of the Russian crisis, the Ukraine crisis, the Russian invasion of Ukraine, does that provide any challenge to the cohesion of OPEC Plus, and now with Iran potentially coming back into the tent?
I think with Iran's return, that's the big question mark, and no one knows exactly, when will they reach a deal, and how immediate will that sanction relief be applied. So obviously a deal could be reached, but then there would need to be inspections. There would need to be a confirmation that a sanction relief could go forward, and that's going to be the a big sticking point here. So I think that for OPEC Plus, this next meeting, they really should go forward with it, assuming that you're not going to see anything immediately out of Iran, and that they should try to weigh a little bit more on everyone else besides Russia to deliver that 400,000 barrel per day increase.
Well,
This is
maybe they're lucky, and some are lucky is a big word, but the fact that the OPEC Plus meeting is happening quite soon this week, although the situation in Ukraine is already bad, it could be a lot worse, and it probably looks like it's going to be a lot worse, which would put a much greater pressure on the cohesion of OPEC Plus meeting than perhaps this week. They'll just get in under the tent in time to do a little quick 15-minute rollover, and none the wiser everybody. We must wrap it up there. Edward Moya, thank you so much for being on this week's edition of Halftime Talk.
Thank you for having me.